and September is famously a weaker month for stocks. We've already seen a lot of volatility, maybe concerning some who stare at their brokerage and retirement accounts. Our next guest says it might not be over. Here with more, we've got Jeremy Bryan, who's the senior portfolio manager at Gradient Investments. I mean, we were all hoping that some of this volatility is over here, but what are you seeing from your lens, Jeremy?
Yeah, I don't think the volatility is over yet. I think we're going to bounce around, but I don't think we're going to have a sustainable trend in either direction. I don't think volatility necessarily means disaster, right? That's not what we're saying here. What we're saying is expect the markets to be choppy. We're gonna trade on a lot of data points here over the next couple of months because we don't have earnings until probably the middle of October to kind of tell us what the consumer sentiment and all that stuff looks like. So we're really trending off of the recent jobs report, what inflation's going to look like, and probably most importantly, what the Fed is going to do at the end of this month. So those are the kinds of things that we'll see ups and downs from, in September. And September, just in and of itself, just for whatever reason, tends to be a slower month and a little bit higher volatility as well.
And so with that in mind, I mean, the September effect is what we've been having the jitters about as of whether or not that will hold supreme as it has in years past. Is that what's formulating from what you're seeing in the mix right now? And how much does the Fed decision that's coming out next week, how does that really kind of push the dial one way or the other?
Yeah, I mean, right now, the probabilities are for 100% for a cut. It's just the magnitude of a cut. So 25 basis points or 50 basis points, which one are they going to do is kind of the thesis in the market right now. So any, real volatility and what I would say pretty negative volatility will come as a result of them saying they're not doing anything. So the market really assumes a cut right now. And so you have to assume that if they're not going to, for whatever reason, they better be out communicating that pretty quickly because the market expects it. And so from our side, the volatility really comes from, like how much of that magnitude of the cut looks like. If they go to 50, the subsequent data points that we're going to see in economic data before they do it, that's also going to have some indication about, are they slowing enough to where 25 basis points is enough? That's the most likely outcome right now. Or are we deteriorating faster than they think and they need to boost it a little bit more and do a 50 basis point cut? So it'll be interesting from that over the next few weeks. But, from our side, we still think a 25 basis point cut is the most likely.
With that in mind, I mean, and as we've been discussing here, and UBS actually noting within their own release this morning saying and talking about how U.S. equities are falling on that mixed U.S. jobs data. And they put within that publish here that the weaker pace of job creation rather than more encouraging aspects of the report, such as a decline in the unemployment rate, that actually had really had more of the outsized effect that we've been discussing here. In the event that we do see continued jitters off of not just what the employment situation is telling us, but perhaps what shows up in CPI later this week, where are those dips and those dip buying opportunities from your perspective as you're kind of looking across where the market could continue to have some unease around the economic data readings that do come out?
Yeah, I think, stocks certainly are not in the bargain bin. Yeah, I mean, there's just no, I can't argue for that at all because we're at elevated valuations still at this point from the S&P 500 as a whole. And we're still up over, in the double digits for the year so far, even though we've come down here a little bit. So from that perspective, we could see further declines. But I would say anything in that true correction territory, that 10% plus correction from all-time highs, I would be looking at that and saying, okay, are there anything that has been overreacted during that time as potentially the opportunity to gain up going forward? In this time right now, if people want to play defense, I think there's no better place to play than defense right now. Defense stocks like Northrop Grumman, like L3 Harris, like Raytheon, those companies are at reasonable valuations already, and their growth profile isn't subject to these things that we're talking about, is that they have different trajectories, and they should be okay given the current environment.
And so as you're leaning further into defense, where would you be taking chips off the table?
Yeah, I mean, look at, what I would say is you have to examine your portfolio in and of itself. And how much risk are you taking in some of the stuff? Is that we saw massive chasing of the AI stocks, right? And I'm not saying the AI stocks are bad. In fact, we own plenty of them here, but we don't own them to the extent that even the S&P 500 has them. We're underweight NVIDIA, we're underweight Apple. These kinds of things, just from a perspective in saying their weight is so significant and they've had such a significant rally, that's an area where I can take some profits from to relocate them into other areas.
Jeremy Bryan, who's the senior portfolio manager over at Gradient Investments. Great to kick off the week with you. Thanks so much.
Thank you.